Good afternoon, trading community. You know what time it is. We are about to conduct our trader strategy meeting where we bring in our team and focus on some of the ideas and maybe trading setups that we have in store for the coming month. We got a lot to talk about today as we have some big events on the horizon. And to get a macro approach, we're going to welcome in Brett Manning, aka Chart Trader. Brett, how are you?
Doing good, Jim. How are you?
I'm doing quite well. So, we have a ton going on this week. We have some economic data. We saw a plethora of PMI data out in Europe, and even CPI in Japan was picking up a little bit. So, we have so much going on. Why don't you start off with the 30,000-foot view and tell us how you're going to approach the markets to figure out your next move?
Yeah, I think that's a good idea. Um, I, it, we need to provide some context at the start. I think at this point, particularly because we do have a really interesting kind of crosswind scenario right now. And you really can't look ahead unless you know where you're looking from and you know where you've been. So the big factor, the big picture narrative, kind of the main idea still driving the bus is really still the Fed's error last year. Inflation jumped. Their mandate said that they had to act to defend price stability, but they were convinced that the inflation readings sort of weren't real. They were misleading artifacts of unusual circumstances, idiosyncratic effects, all related to the pandemic reopening process, and they were right that that was the source of the problem. But as we know now, it would appear wrong about the implications of that situation. And now we're still sitting here a year later with 40-year high inflation readings and inflation that seems pretty resistant to tightening, even as supply chains are opening back up and commodity prices are coming down. However, the market started to bet at this point, over the last, let's say, 6 weeks to 2 months, that we have some tailwinds working in our favor in terms of like a second derivative inflection toward inflation cooling. Terminal policy rate for the Fed is now expected to kind of settle somewhere between maybe 3.25%, 3.75%, rather than 6.5%. And it really depends. It's been fluctuating a lot, but it's kind of in that zone. At least that's what markets are looking at, and that's what you see in the Fed funds futures data when you look out at contracts moving forward for maybe the next year. And we also seem to be kind of the real bullish views. We also seem to be kind of sort of homing in on what appears to be increasing chances of some kind of soft landing, given that the data has strengthened in some respects over the last few weeks from what we were looking for. Even as inflation started to do this kind of second derivative dance toward cooling, it's something in the direction of normalization. I mean, we're still at obviously completely unacceptable levels, and there's a lot of variables ahead. But people are betting that the Fed's tightening is going to be augmented by other factors that are going to help things cool. So that's sort of where we are. And I think the biggest factor from a trading standpoint, is the context for the last 6 weeks to 2 months. It comes out of, and I want people to understand this, that just how bearish the whole market system was when we made those lows in June. I'm not going to recount all the sort of records we set in sentiment and positioning data right now. If you want to see the list, you can go to my macro chart book column in my last edition. I kind of lay it all out, but there were so many different records we set, so many things that had just never happened before in terms of breadth, in terms of positioning, in terms of sentiment when we came into those lows. In a lot of ways, I mean, even though I really don't believe people were emotionally more bearish, the market data suggests there was a more bearish sentiment situation than even post Lehman in 2008. And so that's the context. That's where we're coming from in this rally. Is just people had just left the market for dead, and that makes it really tough to win on the short side. And their hedge funds were so just hammering on that bid all the way through those lows, all the way after those lows, and the range that came off of those lows, and into that last Fed meeting when we got this whole Fed pivot narrative kind of going. And for myself, I was bearish during the first half of the year. We did a lot of work on the short side. I turned bullish in early July, and we did some work on the long side. Ultimately, I probably cut some of those longs off too short, and I was really just looking for sort of a release valve kind of rally, not something that seemed to have constructive, tape properties to it, not something that seemed to be a wall of worry, grinding climb. And I'm really kind of in an internal debate moment as to whether or not we are seeing that kind of next wall of worry sort of build here. If we kind of get if we get the positive scenario from here, there's going to be a lot of people who are caught with way too much cash in the portfolios, and that's what's making it so contentious right in this middle zone. I mean, we have kind of the middle of the bear market, which we're hovering around and dancing through different levels, and we still have like 5 to 6% cash in portfolios, which are really normally historically at 3.5 to 4%, and that's hundreds of billions of dollars of ammunition in that swing. So that's just massive amounts of ammunition that's pinned to the sidelines, with a lot of people on the institutional side really bearish. And one of the notes I posted yesterday is it's kind of like this rally has been more skewed toward like a retail push, and maybe that makes it speculative and empty. And as we saw yesterday in terms of the tape, we saw what happens when you start to get people on their heels in this market, because you're not going to see the strong-handed bid from the institutional side come in and put a brace against it. So it's really sort of the retail people left to just shake themselves out, and that can really feed on itself, especially when you have the hedge funds in there just hammering it down lower. So that sort of dynamic can happen at any time. But if we start to see some of this more institutional side start to feel like they're underexposed, and they start to collect on these things, then it really introduces a new dynamic. And so I think that we're coming into this week with the next big input from the Fed. And I don't know, a lot of people listening may not understand the potential significance of Jackson Hole, and Powell's speech this Friday. But if you were trading, 10 years ago, like, this was everything for the year. Like, there was nothing more important than Jackson Hole. This is when all the important stuff happened. The Fed kind of took it. Bernanke kind of took it at that point as his time to just really lay out, what's going to be happening ahead. And it was, for the month coming into it, everybody was just on the edge of their seat wondering how he would lay things out, because everything at that point was just 100% about monetary policy. It was just, a gigantic QE experiment. And now we're sort of on the other side of that. And it could be really significant, but it also could be much ado about nothing. And I kind of lean in that secondary camp, but I'm not. I don't have a tremendous amount of conviction about that. We have excessive hedging in place. We've got a lot of cash in portfolios. We've got a market that's easy to put on its heels. I think that there's the possibility that we're going to see more volatility into that event. I suppose in my heart of hearts right now, just where equities are concerned, I feel like we can get deep shakeouts. You're going to be able to win on the short side like we did. We closed the Nasdaq short out yesterday for a nice gain. We can turn around and possibly play a squeeze back up, because you're still going to have this dynamic of so much cash in portfolios. And just because it's professional money that's on the sidelines, it doesn't mean that they're not subject to suddenly and completely believing they're at risk of being left behind, or they're wrongly exposed and they need to scramble. So just because it's the so-called dumb money on the long side and smart money on the sidelines doesn't mean this market has to move lower.
All right. So I want to potentially bring Event Trader into the discussion, because I want to take a deeper dive into the Jackson Hole meeting, because that is the big event. Now, it may be much to do about nothing, but what are some of the type of things that we could hear from, I can't even remember. There's more than just There's more than just Fed members at this meeting, and could this be uh, more of a Davos type event?
Well, I mean, basically, the dynamic that we've seen at play over the last couple of months is the market's trying to guess when the rate hike schedule will come to an end, and certainly that push off of June. We had a 2% decline yesterday in the S&P, and that would have been the first decline of 2% or greater that we've had since June 16th, which is, of course, the day after the Fed, when we kind of got that flush out. and then we started moving back higher, is people really kind of started positioning for the idea that the rate hike cycle could start to ease potentially in 2023. And that's kind of what we're going to probably be seeing over the next few months, people trying to guess when this rate hike cycle is going to come to an end. So I think we'd been talking about it a lot before. Equity markets had certainly gotten ahead of the bond markets. There was definitely a pullback in yields on bonds that led to some of the belief that equities should be able to rise higher. But we've seen that reverse over the last week and a half ahead of Powell's speech. Now, Powell's speech should be pretty interesting, and the idea that a lot of people are expecting him to perhaps pivot. And I don't see that towards a more hawkish stance. And I guess the problem I have with that is he's never really pivoted away too much from that. He's certainly thrown out some of the comments about the Fed could start to slowly ease the cycle, but that shouldn't really come as too much of a surprise given that they just did 275 basis point hikes. So for them to start moving into a 50 basis point or something isn't out of the question and shouldn't be considered any sort of change in direction that the Fed's moving. But the market's been very sensitive to this and kind of run with any sort of hint at commentary from Powell suggesting anything but aggressive 75 basis point hikes. Now, for what Powell's going to try to do is just try to reassess the idea that, okay, inflation remains extremely high here, and we're going to continue to battle that, but this is really all kind of commentary that he's already been saying. The question is going to be how the market interprets that, and it's interesting to see some of the price action going into this Powell meeting. So basically hedge funds have tripled their short bets on overnight treasuries here over the last couple of weeks. I think it was something they have purchased over 2.6 million contracts. No, I'm sorry, that's for the euro dollar. They have purchased an unprecedented 695,000 contracts. This is according to the latest Commodity Futures Trading Commission data for the secured overnight financing rate. This is basically the successor to the LIBOR rates.
But you're saying they're
So
shorting it, right?
they are shorting
Yeah.
it,
So,
correct?
in other, just to let everybody know, they're betting on the Fed needing to accelerate its rate
They're
hikes.
betting on the Fed to accelerate, and they have it. The 10-year yields, the bets are for it to move as high as 3.7% within a month. They've also extended the length of maturities on a lot of these options bets to go through to the end of November. So basically, what you have is you have a ton of hedge funds that are just loaded up with the idea that Powell is going to strike a very hawkish tone going into this Jackson Hole meeting. The euro dollar contracts, Brett, for that part, the short wages on them are the highest in over a year, according to the
Was
CFTC.
the same bet. Yeah,
Exactly at 2.6 million contracts. So I think what they're looking for is Powell to basically come out and say 75 basis point is on the radar here. So you have a market that, at least in the short term, is situated to try to hammer higher yields going for yields to start really pushing higher on this, and we've seen that play out in the direction that's been trading. So what's going to be interesting to see is if Powell fails to really hit that overly hawkish tone, then do we see some of these bets start to unwind? And if so, we could get a near term jump in the markets. And that's kind of what I'm looking at over the next 2 weeks for Powell to not really maybe be as hawkish as some people had hoped, for some of these bets to unwind, and that's going to lead equities higher into the back half of August, here into the final week of trade in August, and probably into Labor Day. And I think that that's going to be an opportunity to perhaps reload some of these shorts here that we've seen over the last week and a half or 2 weeks. But that Jackson Hole speech definitely serves to be key in terms of how we're going to trade over the next 2 weeks. And it's not so much the Jackson Hole speech, which I don't think is going to be a marked difference from what Powell's been saying, but how the market reacts and whether or not that's going to force some of these hedge funds to either to cover some of the shorts or at least to buy up, treasuries or equities on the flip side to try to offset some of their losses if we do see yields start kind of declining a little bit. So I think that's the most interesting dynamic that we can watch playing out around this Powell Jackson Hole. Brett, I don't know if you've got any thoughts on this particular dynamic here.
No, so one cautionary note I would throw in is when you look at hedge fund positioning like that, you may be seeing one side of a two-sided thing, and you don't know what the other side is.
Correct.
So, it could be, that there is a also gigantic exposure in some other kind of counterweight side of a much more moderate kind of bet, but you really don't know, and it's possible that all of that is mixed with a massive influx of long positioning in the euro or something. So you don't know how much they'd have to scramble if they're wrong, I guess, is the upshot of that. It could be that this is a naked, gigantic bet. It could be that it's not.
Right, but I would caution that I would not be surprised to see Powell come out what on the surface seems to be hawkish, but for markets to kind of rip higher in light of it. So
Yeah, I
it's
think that's reasonable.
it's a move that people need to certainly be aware of come Friday.
Which is why I'd love to see the initial headline pop be a drop to 40.75 and then buy it.
Yeah.
Well, it's good you brought that up, Brett, because that was going to be my next question at 40.75 level.
What I'd
So
like to see.
you're looking for that on Friday.
I'd like to see it right off the headlines. I mean, I'd like to just see a stab down and you just put a basket under it because that's the overshot of all the stops, and there's just going to be a ton of stops there. I just know it.
Okay, we've got a few days before that though, and I wouldn't be surprised to see us grind down to that over the course of
Or
the
we
next
might
couple
never
of
even
days.
get near
Then
it.
what? Yeah,
We might
that's
never
true.
get near it. So I mean,
But if we do,
this is
all
what we
bets off?
do. You plan ahead for something that may happen and know how you're going to act if it does. And if it doesn't, you're sitting on your hands about it. But that's how I think. That's how I approach things. I generally look at what would be an ideal setup in advance, and I have several kind of in my mind. And when I see them, I know what to do. It's just good to plan ahead for things that might happen, thinking 2 or 3 steps ahead of where you are. And if they don't happen, hey, no harm done. Rather than
Right.
scrambling in the moment and taking something that's not ideal.
For sure, for sure. But we've seen in this market, I mean, that's only about 50 points away right now.
Sure.
And so, we could get there overnight tomorrow, and
But it's
then
quite a bunch of levels in there at 50 points. So,
sure.
right, you gotta blast through those stops. And yeah.
So would you put it on before that, looking for, a rebound ahead, and then reevaluate what you're going to do?
Okay, this is a good question so that I can express my overall philosophy. Um, I it starts with point number 1. I never let myself feel upset in any way about missed opportunities. Point number 1. Most important rule in trading, in my opinion. After 25 years of this, it is the most important rule is to never feel upset about missed opportunities. You think the market's going to go up. You didn't quite catch the entry. You're sitting there without a position. The market's going up a lot. The instinct is to go, oh, man, I can't believe I missed that. Oh, this is terrible. That feeling and allowing yourself to have that emotional experience is massively destructive. You need to not feel bad about it at all. You need to cultivate a sort of internal personal culture around your trading where you just, hey, look, the market's going up anyways without me. That's great. That's fine. Because if you start to feel like pain on missed opportunities where you had a directional bias correct, but you didn't get the setup that you wanted, then you're going to start to take ill-advised setups. There's no way that doesn't translate into that. And a lot of them are going to be wrong. And you're just going to be caught in this washing machine of few good days, few terrible days that gradually grinds you down. You just got to get past that. And so I have a setup in mind that I would like. I've got a directional bias. I'm not going to change the setup. If the setup doesn't occur, I'm not going to take a different setup. Period.
Got it. So you'll reevaluate if we get there and
If it gives me
let it
my
be.
setup, I'm going to make a bunch of money on it. If it doesn't, no harm done.
Got it.
And I'm not going to worry about the fact that I was right about the directional bias, but I didn't make money on it. That's just not going to ever occur to me to feel that way.
I can tell you one of the things that really helped me get past that psychological barrier, Brett, was studying Stoicism. I don't know if you've ever looked into that.
Love
It's
the Stoics.
yeah, the Stoics. That really helped get that mindset of really not caring. But you also, depending on some of the things you read, you can basically get your mind in a very balanced approach, and even losses don't feel like like it's the end of the world.
You know what
It
it
really
is?
does. Go ahead.
You know what it is? Here's the counterbalance to that. I know in advance the pain that I would feel for having an improper trading method. So I'm celebrating the fact that I don't cultivate inside of myself a psychology that's going to lead to my ruin. Right? So it's wonderful to not feel, you understand what I'm saying? So I'm
Absolutely.
not feeling the pain of missing that because I know that feeling that would cause myself. I've been doing this long enough to know where that leads. I know where that path is going, and so I'm celebrating not going down that path. That's definitely going to lead to a lot of bad experiences. So, I don't really need to work at not feeling the bitter regret of missing something that I felt was going to happen, because I know that feeling that is going to lead me to a bunch of ill-advised decisions in the future. I know
And
it.
believe it or not, I believe Marcus Aurelius, he's probably one of the best Stoic teachers. He didn't even know he was doing it. But one
Now
of
we're getting
his
somewhere. We're bringing up Marcus Aurelius in a strategy
well, it's
meeting. We know
important because
we're doing
this was,
something right.
yeah. Well, I mean, one of the things that they do in the teaching of Stoicism is to actually visualize what the worst case scenario is so that you're mentally prepared of what
There
that
you
worst
go.
case scenario
There you
is,
go.
and it
Exactly
does,
right.
and you can know how it feels ahead of time,
Exactly
and
right.
therefore you do your best to avoid it.
Sure.
And if it happens, you actually are already somewhat immune to that
And
feeling.
this sounds complicated, but it's really not. Just, don't beat yourself up over missed opportunities.
Right.
It's just that simple. Like you'll be fine.
So go to the library, do some research on Stoicism, and it should help your trading. So we'll get back to the technical aspect of the trader strategy meeting, but I thought it was important, and it
Sure.
actually
I
really
think it
helped me.
is. I
Yeah,
think it's
for
some of the
sure,
most important stuff.
for sure. All right, so I'm going to shift gears a little bit and bring in blue chip trader Scott. How you been?
I guess I'm an emotional wreck because I don't believe in stoicism. I wear my emotions right on my sleeve and I tell people exactly what I'm feeling and I don't care.
Well, that's the thing. You don't care. That's a
Oh, I
stoic
guess
approach. You
that's it.
don't care.
I guess that is,
Oh,
so
he
it's not
got you on that one, Scott.
so it's not pure like statuesque sort of
No,
approach. You're
no.
not like showing no emotion. You're just doing what you got to do
Do
and
what you
not
got to do.
really worrying about it, right?
Right.
Okay.
Sure.
There's
Okay.
different schools of thought there. But one of the reasons why I wanted to bring you in right
Yeah.
now is
Yeah.
because you are so good at bobbing and weaving this market. And we've had ups and downs. You were out in front of that whole wall of worry. We talked about it in the last trader
Yeah.
strategy meeting. You highlighted how the August and July time period happens to um, have
Be strong.
the be
Hmm.
strong based on the cyclicality of everything.
Hmm.
So now that we're at the end of August, how you looking?
Not as bullish as I was. If we do just backtrack a little bit and go to about a month ago or a couple weeks ago, yeah, I was pretty bullish. And the main reason I was bullish was everybody else was bearish. There was nothing good out there 2 months ago going around that Fourth of July holiday. Sentiment was, decade lows. Um, Charts looked really bad. Just there was nothing really good on the horizon, and when you really kind of just throw the whole baby with the bathwater out there and everything looks so bleak, it's the hardest time to step up there and just kind of take that contrarian view. But that was really kind of the mindset that had to be taken to capitalize on the rally that we have seen here the last 2 months or so. Now, with that said, we did have a much bigger rally, similar to what Brett said, the last couple of weeks here, especially into August, that extended to the upside without really getting a significant sort of pullback. Just kind of climb that wall of worry, like you said. And it did take the moving averages, the major indices up to their 200-day moving averages. It did put RSI, which is a very popular technical indicator, into its overbought state over the 70 readings for a couple of days there. I think it was just actually over a week in some instances. And so it kind of gets this whole feel of the market's gone up too far, too fast, and needs to pull back and correct. And here we are with earnings season, on the tail end of things, getting wrapped up a little bit. And the market's just kind of pulling back off those highs. The volatility's picked up recently. Obviously, the VIX jumped about to 24 after yesterday's gap down. And I think we're just kind of due for this backing and filling sort of action on the chart here while we enter like the dog days of the summer doldrums here up until Labor Day and around September. And not to mention too the 50-day moving average on the S&P. The S&P was over 9% last week above the 50-day moving average when I tagged the 200-day moving average. So it just kind of felt overbought short term. It was tough to kind of get too aggressively short because it wasn't really quite peaks usually don't happen in this V bottom or V top, I should say, sort of fashion. It takes time. Usually it takes a few days for people to kind of come around to that. But now here it is. You see people a little bit more bearish. I would almost say too aggressively bearish in some cases. I am seeing some short-term indicators get into some negative territory here, which is probably going to wind up resulting in some sort of bounce that's going to wind up resulting into some sort of choppy trading activity here over the next, I'd say, 2 to 3 weeks going into that early September timeframe. And I think that's just going to basically have the S&P locked in between the 200-day and the 50-day moving averages. Until something else, kind of develops out of that. Now, as for the rest of the year, I'm on board with everybody else. Bigger picture macro stuff. You got the Fed maintaining a hawkish stance there. Higher rates mean there's going to be a stronger U.S. dollar. And if anybody's been tracking the UUP, that's been on the rise again lately, breaking out after a little bit of a multi-week consolidation, hung around the 50-day moving average 2 weeks ago, and now it's back up near the highs there. So they're going to be, that's basically the main premise behind the market there. Obviously, you're going to have interest rates themselves, the 10 years moving back up to 3% there as of late. So that's going to be rising a little bit higher there. And I think inflation concerns are going to slow down. I'm not saying it's going away. I just think that the Fed is doing a pretty good job at getting that soft landing that they've been talking about. So I do think that as a whole, since that the market's reacting the way it should and it's discounting everything that's predicted out there to a certain degree, I think that's going to basically lead to some sort of improvement in equities overall. After we get this little bit of backing and filling here over the next few weeks. And I think it's going to lead to a pretty good fourth quarter overall. Also, if you think about just fourth quarters in general, from a presidential cycle, this is the second year of a new presidential cycle, which is often the most underperforming of the 4 years. And we're going into the back end of that. We're almost 3/4 of the way through. So I wouldn't say the worst is behind us, but we've fulfilled that cycle, that prophecy of that cycle, and that does kind of set us up for a little bit more of a bullish vibe on the back end of things. As for sectors that have been strong, in this stage of the economic cycle, you should still have some staples in your portfolio because there is that rising rate environment that has everybody concerned a little bit, and that is going to put pressure on technology and growth oriented stocks, and the value stocks tend to do a little bit better. So I would say you have to be a little bit more oriented on a defensive perspective there. Have some food and beverages stocks, have some cereal stocks that are doing pretty well in your portfolio. Healthcare, you can even dive a little bit into there. So we've seen some healthcare providers do really well the last few weeks. So maybe throw a little bit of that in there. Utilities have been doing pretty good as well in that defensive measure, especially the water utilities. Gavin and I have been talking about that on the Trader Audio in the afternoons. PHO, PIO, and CGW are some ETFs to take a look at. And they've been just really outperforming a lot of the market here in the last month or so. I'd keep them on the radar.
What were those water ETFs again?
PHO, Peter,
Hmm.
Henry, Oscar. PIO, Peter, Indigo, Oscar. And CGW, Charlie, George, William.
Got
So
it.
those are the main ones that I'm looking at. Um, uh, let's see. Otherwise, short term wise, I mean, natural gas has been, taking, rocketing higher there. UNG is the ETF on that one. Obviously, it's a direct reaction to the Russia-Ukraine situation with Europe. So that's been moving to the upside there. We've seen a lot of energy stocks creeping up the right side of the charts there. Even solar, I would throw in the TAN as an alternative asset group that's been looking really good here this summer. Ever since that breakout in late July, it's been holding on to those gains there. So I would keep them on the radar there. Um, let's see, agricultural stocks have been moving up to the right side of the charts lately. That's CF. NTR broke out today. We had that one on the radar. We were talking about that a little bit. Up $4 now. Nice clean breakout there from a little bit of a consolidation pattern on the charts. NTR is a nice one. IPI was another one. I don't know if this one was getting bought out or not. It had some weird looking chart action the last 2 months or so. Really tight, narrow range for IPI, the potash stock. But I got a pretty decent breakout on that one today. Um, Also climbing up my list, I like the lithium stocks. If we're going to talk about some energy and alternative energy names, LIT. That's a pretty solid looking chart here. It's gone through a corrective phase. I know it's more growth oriented and it's focused on the EV plays, but it is rounding out a decent bottom over the last 4 or 5 months or so. Had a little bit of a breakout here in August. It pulled back aggressively. It's showing relative strength here today, which I definitely like. So I would keep LIT on the radar. And then just to kind of dig a little deeper in that lithium area, no pun intended, let's go with metals and mining. XME is a nice ETF that's been also rallying up the right side of the chart lately. A little bit of a pullback there. This is going to consist of some copper stocks, so something like COPX is a good ETF to monitor there. Freeport McMoran is looking pretty good on the charts here. I've been long this one. About $27, $28 the last few weeks here. But I do like the setup there. Steel stocks are looking pretty good. Basic materials, industrials, all nice solid pullbacks, showing some good relative strength here today. Uh, and I think that the industrial space is actually picking up as well. We have the transports doing good, and then I'd even swing that around to some of the infrastructure plays. Something like a PAVE is another ETF you might track, or the IFRA infrastructure plays. Um, and then, sure, why not throw some financials in there too? If we got a rising rate environment, we should see some of these broker dealers and banks, regional banks do pretty well. So again, I think you have a good opportunity for like a well-rounded, diversified portfolio, a little bit defensive, a little bit more on a recovery effort here in the back half of the year. The only group, if you notice, that I'm really leaving out is technology and discretionary. I think those are the leaders in the last bull cycle on the way up, and the cloud computing and the software names and semis. They're fun to trade. They're definitely more popular and they're definitely volatile. But I think if you're trying to, you know, do a little bit more of an intermediate term portfolio, sector rotation, relative strength, and relative weakness, I think that the groups that I just highlighted are really going to be your main, should be like your core focus over the next couple of weeks, next couple of months, um, and less on the heavy weighted technology, semi software side of things. So that's my overall look there for that.
There was one more that you left out, and
Okay.
you kind of mentioned it. I just want to make sure that I understood it, and then everyone else hopefully can as well. You said earlier in the discussion, you think that there's pretty decent potential for a strong Q4, and that would imply that we have consumer discretionary names. And I just wanted to make sure. I thought you said that you left that out of your portfolio construction just a minute ago. So, where do you
Yeah.
stand on consumer discretionary names, particularly heading into the back half and the end of the year?
Yeah, so discretionary, obviously, if you're looking at something like the XLY,
Hmm.
that's a tough. I think that's a tough gauge because the XLY is heavily weighted in Tesla and Amazon, and so that kind of falls in
Mm.
that whole sort of. Those are like the top two weighted names there, and then right behind it, you have more of your Home Depot, which is more of, and Lowe's, which is more of the housing market, and then you're gonna have something like a McDonald's, which is more food oriented. So discretionary,
Maybe be a
you
little
know,
more stock specific, huh?
it falls more to an industry than an actual sector. And like you can look at some of these discount retailers like a Walmart or a Costco, BJ's Wholesale we talked about lately, or a Dollar Tree. Yeah, so I think you have to dig a little bit deeper if you want to go into the discretionary area. And I really haven't. I just, like I said, how there's just too many moving parts in that group there. I think to really kind of to narrow it down and just give a vague statement of consumer discretionary. Does that clear? Does that make
Yeah,
sense?
yeah, it does. And that's good. I'm glad you brought that up because we had a discussion this morning with Gavin where we talked about Macy's and their inventory. So that might be
Mm,
one that we
okay.
focus on if you want to get some consumer discretionary exposure, just come back down to more specific names that rather than just throwing a whole
Yeah.
sector ETF in your portfolio like in XLY. So, no, that's
Yeah.
good insight there.
Yeah. Discretionary is just it's so broad. I mean, you could throw travel in there too, and you could
Mhm.
throw cruise lines and Starbucks is in there. I mean, it's Nike. I mean, it's all over the map. The top like 25 holdings. So it's good diversified, discretionary area. But um, it's tough to say whether it's like disposable income or whether it's actually necessity sort of stuff. And yeah, you got to dig a little deeper on that stuff.
Gotcha. All right, I want to bring in Trend Tracker. Craig, how you been?
Good, Jim. How are you?
I'm doing well. So you threw out a name yesterday that I got to ask you about. It wasn't on my radar, and it's seen its fair share of volatility in just a couple of days of trading. That would be AKLI. Talk to us about this one, why you like it, and what's going on.
Well, this was a job of risk management on my part. I did scale into it yesterday, and I'm at a 60% of a full position right now, and I am tempted to add here, average in. But this is another spec from Chamath Palihapitiya, who at this point does not have a good track record. Um, and, there was obviously a ton of momentum yesterday, or that's Friday evening, afternoon, and it continued yesterday morning. And I thought we were going to see another one of these, we saw HKD or, whether or not we call it a meme stock, just like a massive kind of short squeeze. Um, Reading through more of the filings, I think the flow might be at least 8 million shares. I had seen that it was a lot smaller than that, or like 99% of the DAC investors, the previous ticker DNA was. So there was this initial short squeeze, and there's nothing ever since. It is a very interesting company. They're going after a big market when it comes to ADD, basically central nervous system issues, which is extremely prevalent in this country and pretty much everywhere. So it's it's a big market, but it's a SPAC, a somewhat shady at this point, less than stellar reputation sponsor. So, it's a risky stock if the PO market is shut down right now. But the case that you can make for a lot of these SPACs, if it was such a great company, why didn't they just come do an IPO? At least you could have said that last year. The IPO market is pretty much frozen right now. Most of these. But yeah, I mean, I do think it's a matter of time before some of the money will come back in this thing. I mean, we saw go to as high as 60. I guess it was Friday afternoon, and it looks like it's kind of left for dead here. But I do think it's just a matter of time before momentum comes back in because it's going after the market that has potential. It's essentially an FDA-approved video game to help people with ADHD. And right now it's just approved for 8 to 12-year-olds. They're going to have data in the coming year or two that will expand it to teens, adults, I think even younger kids. And they also will have data expanding it to depression and autism and multiple sclerosis. It's a highly speculative stock. And if momentum does return here, it could see a pretty sharp move. Obviously, yesterday was pretty aggressive, so we'll see what happens.
Well, I also think it's a good time to bring in Scalp Trader Damon. How are you?
Hey, Jim, I'm well.
So we were talking about this AKLI, and you are kind of the SPAC go-to person. And I would love to get your thoughts on this one. You haven't been involved in it. Just kind of give us your thoughts on the activity in this name, where it's been, if you like it, if you know as much about it as Craig does, because I know you do a lot of research in these SPACs. So I'll give you the floor on this one, AKLI.
Oh, so I took a look at it yesterday, and I mean, it looks interesting. I mean, obviously, there could be a strong market for something like this. And I mean, initially, I think the idea was, for Craig, was playing the squeeze after the huge redemption, which leaves a really small float. And that has been a great trade in SPACs, especially the past 6 weeks or so. SPACs that, high redemption, low float, and you get 100, 200, 300%. I mean, I think they're the one that really kind of got things going a few months ago. I mean, I think it went up like 500-600% in one day. So definitely there's a history of these types of things running. And, once they break the $10 SPAC price and start to pull back a little bit, you just really have to think about where everyone is positioned. Insiders aren't going to be. I haven't looked at this deal in detail. Like, I'm not sure if they did a pipe or not, and just how big that pipe is, and what the pipe is allowed to essentially be unleashed when they're allowed to start selling the pipe. So I would have to dig into that a little bit more. But that'll be your initial overhead of shares of people, investors who, if there was a really high redemption, in order to get the deal done, usually companies will have to go out and do like a secondary offering to bring in money. And the terms on those have kind of loosened quite a bit lately. So it could be available to kind of liquidate or to sell pretty quickly. That's something definitely to take a look at.
Yeah, so Chamath was $100 million in the pipe. He tweeted.
He invested $100 million in the pipe.
Yeah.
Okay. Well, I would imagine that if he's involved in the pipe, they probably have it locked up, longer than 24 hours. So, I mean,
You would think so.
I would think it's probably at least a month to maybe 6 months. But it's something I'll take a look at it, and I'll share with Craig what I come up with.
All right. So, Craig, you were considering getting involved in this one, adding to it. What's your price target? Maybe 5 is where you're looking, or you think it might not get there? What's your thoughts on that?
Well, I'm just gonna watch it for now. I had a place to stop under 6 for pretty much where it is now. Yesterday, and I'm not ready to bust yet. So I'm, considering just averaging in here, but I would like to see a little bit more encouraging price action before I do that. Maybe some life in this stock. But yeah, right now my cost is up closer to 14, 13 and change. So, I do want to average in ahead of any momentum coming into the stock, but I obviously don't want to keep buying all the way down. So I'm just watching it now.
Okay. Your mic's breaking up a little bit, so I'm going to bring in Scalp Trader real quick. Damon, so you've been playing around in a bit more momentum names lately, doing some old school day trading the last week or two. So what's going on there, and what are you seeing?
Yeah, so I mean, the market seems just more normal to me. I feel more comfortable in this market. I mean, I think it was very difficult. I don't really trade short, especially individual stocks. So to just have basically an offer, basically overhead supply for month after month after month after month, where stocks are just getting crushed straight down, was difficult for my trading style. But what it did create was the opportunity to find some names that got very, very cheap. And, once the market started to run, had really strong performance pretty quickly. And the other thing is that with rates rising and yield instruments, income opportunities getting hammered, it created the opportunity to put some of those names back into the portfolio, which is kind of one of my core strategies, the high yield income strategy. So I've been very excited about that. I mean, I've been really excited for waking up in the morning, seeing that you have like a dividend or distribution posted to your account. To me, it's like, yeah, I mean, it's like you're getting money for not doing anything. And if you buy these positions right, you collect a double-digit yield, experience capital appreciation of 10, 20, 30%. And I consider it the gift that keeps on giving. So I think that, you're starting to see rates tick up again, and some of those names are starting to pull back. With rising rates, my focus will be on business development corps that are yielding 9 to 12%, that have floating rate loans outstanding. So the rising rates, their loans adjust automatically. So some of these companies actually will make a lot more money because of rising rates. The other side of that coin will be preferreds in particular will start to pull back in price because the yields will become less competitive to say where the 10-year treasury is. And I think there will be an opportunity to pick up some of those names at cheaper prices. And if rates start to really feel like they're spiraling out of control, those names will get hit initially, but then start to bounce as the market thinks the Fed's going to have to raise rates and create a major recession. So waiting for like some type of major economic data, some economic report that really sparks inflation fears and hammers those prefers before coming back in with a new batch of those.
So with this recent rally that we've seen over the last few weeks, you've been able to take some profit on some of those distressed names that you got in on earlier this summer. Are there any other distressed names that you're continuing to keep an eye on that may be flying under the radar?
I want to let things get a little more distressed. I mean, actually, this name NRDY Nerdy, which is a name we've owned in the past, which is another busted SPAC. That was one that was on my radar, and it's up 37% today after the CEO. I think he bought 5 million shares. It was disclosed just a few hours ago. So one of the things I like about the busted SPACs, and I've kind of been saying this for over a year, and it's taking a little time for them to really become as busted as I'd really like them to. But some of these names are, I mean, they're going to underperform, to the whole, have outsized, they're going to become so cheap and so out of favor that they become takeover targets. And you'll see management insiders buying the shares, and you'll also start to see actual takeovers. And so I think we got to that point in June, which is when I started to really start to add more swing positions. A lot of those have bounced pretty aggressively. And, I'd like to see them come back in more before reestablishing positions.
This may be a silly question, but how does it work? Are insiders allowed to buy if they know a takeover is coming?
No, not if they know a takeover is coming, but so a company like Nerdy, for example, right? They're in the education space. There has been reports that some of the education players are seeing takeover interest, and companies CEOs should know the value of their enterprise relative to competitors or peers. Just because the market is saying one thing doesn't mean that's kind of where the kind of the true fundamental price of the asset is. I mean, just like with the Saudi oil minister came out yesterday and said, hey, the price of oil doesn't reflect the true market dynamics, so we're going to have to cut production or something because you guys aren't trading us at a fair value. The same thing happens in stocks, and I think you've started to see more takeovers in the equity markets. And I think if you see another pullback, there's just so much money out there on the sideline that you will continue to see M&A, once things get cheap again.
All right. So, Brett, I want to bring you back because you had laid out a recent post about the potential opportunity in the emerging markets. Can you give us an overview of that idea and how it ties into your overall assessment?
Yeah, sure. So as I put in that post, it's really, in my opinion, it's kind of thinking around the corner, and already part of that corner has been traversed in the last week, because this is really you know what, I think that it's the type of idea that would really appeal to Scalp if he took a look at it, and perhaps he'll sort of partner with me in outlining this idea, because the emerging market space is already basically like the cheapest factor bet that exists in the world. People have just thrown away the notion that emerging markets can be successful investments, and you're dealing with, like, sky high dividend yields, rock bottom PEs, and they really haven't rallied with anything that's happening now. A lot of that's geopolitical. There's a number of different reasons for it. One of the big ones, though, is the bull market. That's the sort of unstoppable bull market we've seen in the U.S. dollar. Over the course of this year, with the Fed so far out in front of everything, you got these huge kind of interest rate imbalances around the world, and that's just the way the forex market works. Like, there's just forced flows. So and as I said last week when I posted this, it looks to me like the situation with the dollar is just going to get worse first, because we're going to be. So this is what's so interesting about this to me. So you've got something that's already just completely left for dead, and I guess the idea to me, what makes it compelling, is that I think that it's going to crash again, and that that puts it in a situation that's just, it could be like a once in a generation kind of opportunity, because it's already so left for dead, and then we could get this sort of extra leg of just something that over the coming 10 to 15 years, looking at it in a long term, could be great. And it's just at one of those moments, and that extra sort of leg, I think. So a lot of emerging market bets are, they're contextualized by their economic environment, and there's, when the dollar has a big bull market going, a lot of the debt can't be serviced in these countries very easily. Another way to look at a dollar bull market is just a difficult time accessing dollars, and when you have to denominate all your debt in dollars, a foreign currency, and you can't print it, everything gets kind of underpriced and undervalued that's in anywhere in the orbit of that system. And that's kind of what we have here. there's a lot of speculation that we could see some defaults, we could see some toppled systems, and everybody is pulled way back. And if we get another spike in the dollar, which it kind of looks like we're getting right now, then it lines up this opportunity. And the cause of that next spike, in my opinion, is really about the euro moving decisively under parity, and that's really about discounting the possibility of a genuine, really impossible to navigate energy crisis in the EU. And this comes back to Ukraine, and it comes back to Putin looking for leverage. And he's in a position to cut off the gas. He's kind of sent that signal several times. He just sent it again last week, where he can just, we've got a technical problem with such and such pipeline, we're going to shut this down for a few days, just to give, I think, just to kind of give EU countries the sense of, here's how bad it would be if we don't deal with this guy. Suddenly we're having a complete lack of energy. And if you just have a short-term situation where you can't access enough energy in an economy the size of, say, Germany, that's a deep recession just in and of itself, right there. That's it. So you end up with a lot of pain just on the basis of that very, even a short-term situation. And the prospects of it being a larger time frame situation, obviously they're scrambling. The infrastructure timeline just makes it impossible for them to account for this before this winter. There's no way they can build enough like LNG terminals, and they can expand in any form what they're doing to account for this. So they're going to have to deal with them. So they put themselves in this position. Putin takes advantage of it. He gains his leverage. Who knows how those, if we head into a negotiation side of this, where that's really something that can impact this, but markets in the meantime are going to discount the possibility that the EU is just headed into a really terrible situation over the next few months, with really that it's about the winter when they would be most vulnerable to a complete lack of access to energy. And I think that scenario is already starting to play out, and I think it's the number one thing that's driving the euro through the ground right now. And all of that really, because it translates through the dollar in terms of the ability of emerging markets to service their debt, it just takes the cheapest thing in the world and makes it much cheaper. But there is going to be the other side of this. The wave is going to break, and when it does, it's just going to leave these things just so dirt cheap. And I just got to feel like we're building towards a kind of generational opportunity in terms of emerging market exposure.
Yeah. Are there some specific countries that look interesting to you,
So
Brett?
I need to do that work, and I don't have that answer right now. I understand it as a factor bet, and I do need to come up with a better implementation than just EEM, but that works in front of me.
Okay. I
And in
have a
terms,
question for you.
oh, go ahead.
Yeah, so obviously, this energy situation in Europe is a big deal, and we're not that far away from winter. Do you guys have any thoughts on how that plays out and what it does to global equity markets? The idea of people in Germany and in the EU not being able to heat their homes, or factories having to scale back production because they can't get enough natural gas.
Well, I know from my perspective, I've been buying PXD, and talking about the nat gas plays. I mean, we got nat gas over $10 now in the markets, and I think we're just kind of getting that ramp up at this point. You look at another name like EOG, another gas producer there, that they both have great looking charts pushing over the 50 and 200-day moving averages and breaking higher. I'm expecting PXD to get back up towards that 290 area. So that's kind of how I'm looking at a way of playing that. Outside of that, you get, as Brett was saying, you're going to have that euro under pressure too. So, if you're looking at some of the names that have talked about the FX impacts that they're going to be seeing from there, any name that's got a extensive exposure to Europe on the multinational side, I think that's another one that you got to line up on the short side of things. That's kind of how I'm looking to play in it.
Can you guys hear
Yeah.
me?
Go ahead, Craig. Yeah, I can hear you, Craig. Go ahead.
Okay. So, well, I was, from my perspective, I think you kind of have to meld everything that you said, blue chip, and everything that Chart Trader said as well. And what was strong in this most recent round was utilities and Apple and all the worst stocks in the market. So obviously the short squeezes weren't sustainable, and those have rolled over. And the utilities, I believe, were the only thing that hit a 52-week high last week in terms of like a sector. And we're finally starting to see oil and commodities come back, which is what was working the first half of the year when all these growth tech stocks were in favor. And as you noted, blue chip, like that is what's really not, doesn't seem like it's going to work. And, the broader tech, if you look at, I've been pointing out mega cap is, well, if you look at it, it's like almost 40% of the market if you add the Tesla and the Amazon. So that's a little discretionary, and the comm services. So Apple's the only thing above the 200-day right now. So that's where I don't think this market can work. We're probably going to be maybe sideways or range bound, but it's hard to be bullish when tech isn't working and Apple's the only one over the 200-day. I feel like it's just a matter of time before Apple rolls over, and just as for all the reasons that Brett were pointing to. If you're not long energy or materials right now, or maybe utility because they're defensive, it's the outlook seems pretty mixed at best here going forward.
Yeah,
well,
I
I have to
agree.
say I own some PXD thanks to you guys, so thank you.
Oh, you should have owned LNG. I think LNG might have been the better play. Shinnery Energy has been doing really well. LNG,
yes.
CHK.
So LNG is one of the direct beneficiaries of bringing LNG to Europe.
Mm-hmm.
So that's a great trade, and I'm sure everybody knows I've been in DVN. That was in our last strategy meeting. Really, my only was my parting shot because it was a 10% yield a few weeks ago, and now it's maybe high single digits. But we've kind of shifted. We've quickly shifted back to the market we had in the first half of the year, which just you don't want to be high multiple. You don't want to be long high multiple tech stocks because the Fed is selling calls effectively, right? So I hear everything that you were saying, blue chip. But my conclusion is a little different because tech doesn't seem like it's going to participate very much.
No, I agree. Again, I'm a chartist. I just look where the money's flowing on the screen there. That's it. And I follow those trends. FCG, Frank Charlie George, is the natural gas ETF. If anyone's looking for a more diversified play, with the winter coming in Europe there. But I think just also good point there, Craig. If the market is still heavily weighted in the technology and discretionary areas and communications areas, I mean, that you can almost make the argument that's the flaw of having market cap weighted indices. And so, things are going to struggle a little bit. And that tells me that going into the next couple quarters, this really is probably going to become more of a stock pickers market. It's going to become more of a sector allocation market. You're really going to have to, just going into a passive sort of fund, index fund, is probably not going to be the best returns in the world because they still have those heavy weightings in technology. And I think you have to maybe diversify a little bit into all those groups that I was saying a little bit earlier. So,
I got a question since we're talking a lot of energy here going into the winter time frame. Obviously, people take their cue off of what crude oil futures are doing. I got a question for you, Brett. Do you know anything? I've seen a lot of headlines. I haven't dug too deep into it about the lack of liquidity going on in the crude oil futures. I know, I believe MBS, the Saudi prince, was out making hints that something odd is going on in there. A lot of talks on TV about it too. Have you read in anything about this, and are you seeing any impacts to crude futures that could be potentially misleading?
So I have not noticed it in terms of tape reading. I haven't noticed something that looks odd to me. I can imagine that there's an imbalance right now, and the imbalance is this is the tightest physical oil market in history, and you've got a financial market and a physical market, and it's the same thing that OPEC has been talking about the last few days, where they're like, this seems like they're right. they're perfectly correct. I don't know why. I mean, markets are markets. The physical side's the physical side, and these things can get out of balance. They come back together, but when you get into a situation where you've got a particularly dire situation and a super tight market, and then you've got the futures kind of leading things lower, I can imagine that there's some kind of mechanical market effects that are being noticed. I don't know any particular answer deeper than that, but I will tell you something else that kind of ties the last two topics together. Um, you've got the oil market, and then you've got sort of its derivative products, and its derivative products flow into multiple streams, and something that I would point out as a kind of canary in the coal mine for, let's say, the sort of worst case scenario in Europe playing out would be if you can get the data, if you're looking at a ratio between heating oil futures and RBOB gasoline futures, you'd have two different sort of tracks that flow down. They're downstream from the crude oil market, and there's no substitution effects between them, but there is a substitution effect between heating oil and fuel oil, and there isn't between RBOB gasoline and fuel oil. And the upshot of that is, if things get desperate enough, because again, you can't get the infrastructure in place to solve the EU's energy crisis for this winter with natural gas imports from the US. It's simply not possible. So if you're getting into a situation where you're heading toward this crisis, there's going to be a lot of substitution toward fuel oil, and the kind of offshot of this is this could spike crude oil, because you can start using crude oil to make up for missing natural gas, and you'll know that that's happening when you start to see heating oil futures take off relative to gasoline futures, because it means that you're seeing the substitution effect from diesel fuel oil to heating oil, and you're not seeing it in RBOB gasoline. In other words, it's not a basic energy effect from the typical way that we use crude oil. We're starting to use much more crude oil for substituting for natural gas if you start to see that relationship skew abnormally. So that'd be the ratio between heating oil and RBOB gasoline. If that starts to spike, and for what it's worth, I can see it, and it's been spiking for the last few days, but not crazy. But I mean, it's at apart from 3 different days, it's at its highest level in several years right now. So we're starting to see some substitution effect, and you could see that intensify a lot, and that could really drive crude oil higher.
All right, I'm gonna
have to go back and re-listen to the recording of that.
Okay, well, let me simplify for anybody else who feels the same way you do. If you don't have enough natural gas, you use natural gas for electricity. You need them to power factories and stuff like that. You can use crude oil to do that too, but it's more expensive. But if natural gas gets so expensive because it's so short in supply, you start using much more of a derivative of crude oil to make up for that missing factor. So you'll see that. The way that you'll see that that's happening is if the ratio in the price of heating oil to the ratio in the price of RBOB gasoline starts to sprint higher, because you'll know that we're drawing a lot more crude oil for use as electricity.
Right, and I pulled up a chart. I have heating oil. Well, it's not showing on the screen, but on my own screen, I have heating oil versus the gasoline contracts. And you're right, it is at the highest level in about 2 years. Yeah.
go ahead and show that. Go ahead and show that for recording purposes.
Sure. Give me 1 second. I gotta just make an adjustment here. Feel free to speak amongst yourselves. Are we gonna wrap things up right now, too?
Most likely, unless there's some parting shots. But go ahead and put that chart up just so people have a frame of reference when you guys go back and listen to everything.
Yeah, I mean, and so it is an open question as to whether or not we're going to reach this crisis, because again, this is geopolitical. People can reach resolutions to cut this off. Like the leaders in the EU know that they're over a barrel on it, and they may concede on many things. And this is a threat that's out there, not an actual strike.
Also, other areas that could benefit from that, Brett, nuclear. You could start seeing a lot more about.
Yeah, but that's long term. Like, I mean, if they're talking about this winter.
No, I'm not arguing that they could just turn the plants back on. Well, Germany, they're just turning it off at the end of the year, right? So
yeah, but they extended that, didn't they? I mean, I think that they've come out with commentary that suggests they're extending. I mean, obviously they're
did they officially extend it, but the bottom line.
Whatever they say, that's what's happening. I can
Right,
promise that.
exactly. The problem, but I'm just saying, keeping like CCJ on the radar. U is another
Sure.
energy fuels. So definitely keep those nuclear plays close at hand too, as other derivative plays off of nat gas and oil.
On the screen.
Yeah. So there you go.
There was a big spike, I guess, during COVID at that time too.
Yeah, right. But who knows? I mean, the way that's not that's an odd effect. But if I would just take that out. Pretend you don't see that part of it. Look at the whole
Yeah.
rest of the chart, and you can see the sort of much more constructively trending thing that's just starting to take hold, and it's related to Europe right now.
I'll have to look closer, Brett, but I have crude on the bottom of this chart here, and maybe I'm interpreting this wrong, but it looks like when that relationship that you mentioned, when heating
Well, in the past,
oil.
it hasn't been related to an energy shortage. So whatever the reason
Oh,
is, it's
okay.
not the same thing. What we're looking at now. So
Crude
again,
oil.
this isn't heating. So this is just that there's a substitution effect between diesel fuel oil and heating oil
Okay.
for reasons other than electricity. And so you can see the diesel fuel oil effect coming. So in other words, this is increasing demand for using oil to substitute for natural gas in the generation of electricity. In the past, when you see this relationship change, that's not what it means, because that's just heating oil versus gasoline.
Gotcha.
I think that spike might have been remember when crude oil took that
Futures
big
went to
dive
zero.
and
Yeah, there went to
through
Yeah,
zero.
zero?
that's it. That was
So I
it.
Below
think
zero, negative 40.
that skewed it. So yeah,
Yeah.
you really could throw
Cancel it
that.
out. Look at the
Right.
rest of the chart.
So, one more thing for me, and then if anyone else has any follow-on questions, you can go ahead. But this one for you, Brett. A couple weeks ago, we saw the tension that the market had because Nancy Pelosi went to go visit Taiwan. So I guess we should at least handicap the prospects of the turmoil that could develop if there is some more action with China and Taiwan. I guess get the prospects of that out there.
Yeah, and what am I?
Well, I mean,
Sure.
what I mean, it would be some type of black swan event. Everyone was watching it. The market's on guard. Um, what I mean, what are you hearing out there? I mean, you have a lot of contacts in the industry and a lot of thoughts and game theory. I just wanted to know what you thought about the prospects that China may engage with something more serious with Taiwan.
Yeah, I mean, it's like this. It's like inevitable on some level. I mean, this is going to be like the biggest chess piece on the board,
Mm.
and there's staunchly opposed ideas, but then there's also there's too many factors for me to attempt to I think to game that out. Really, I'm in the same position as anybody else of just what happens next, whatever it is related to that story, is something that I know that I can't predict. And I'm just gonna have to take it as it comes. It's certainly a big thing, and there's going to be more stuff related to it. And I really don't know that I can factor that in any way where I feel like I have an edge over any given conception of the average other market participant where that factor is concerned, I guess.
Would the first financial impact be in the bond market, though?
I mean, there's certainly the possibility, because you can weaponize
Mm-hmm.
China's bond holdings as one way that they could demonstrate some kind of threat. Hey, imagine if your interest rates went to 10% tomorrow. But I don't know if anybody's going to take that seriously, because that would just be destroying themselves. So, and I mean, there's a lot of China's got its own internal problems to deal with, and it's got a lot of them.
Yeah, for sure. That real estate dilemma is
Well, it's just the
not
terrible
going away.
demographic time bomb coming at them too. So they've got a lot of difficult situations that have nothing to do with Taiwan and nothing to do with us. They may make this more manageable in terms of how they want to position themselves. I guess I really worry more than anything else about what their relationship with Russia really entails behind the scenes, and I think
Mhm.
that's going to be an evolving situation.
I would also throw out, just from China, the water story also spreads out to there, where they've had to shut down factories because they can't get enough water. So, when you're just looking at these water plays, keep stuff like that in the back of your mind. I saw, Brett, I don't know if you saw this, they're making chemicals to shoot up into the clouds in order to try to make it rain. I don't see any
Herschel Walker's going to
downside
have
from
something to
that.
say about that, I think.
Herschel Walker might have something for sure. But yeah, so there's a lot more issues in China than just the housing issue at play too. Their water shortage is being not allowing them to run their factories at full steam too. That's an underappreciated story that I think bears watching moving forward.
All right.
Any other thoughts you guys wanted to toss out there?
I'm good.
That's it for me.
All right, then I will take that as a collective no, and therefore we will wrap this one up. I would highly advise going back and listening to this one. There was such a lot of information to go back. I'm probably going to listen to it a few times myself. So, with that said, gentlemen, I want to thank you all. I want to thank the audience for joining us today. And again, if you do have any questions for these guys, they're really good about getting back. Leave your email. That's always the best way to get a response if you don't hear anything on the air. So, with that said, thank you guys, and we'll do it all again next month.
Thanks, Jim.
Okay,
Cool.
bye.